Welcome back in, ladies and gentlemen. In this video, there is a few stocks that I'm adding to my watch list that I just want to share with you. Now, the first one, probably a little contrarian. I'm going to throw a little curveball here. Trades at a single-digit PE ratio, recently had quarterly earnings that disappointed, and the stock sold off drastically. This company is yielding a double-digit free cash flow yield and paying over a 3% dividend. Company's been around for over 100 years, and if you guessed it, it's going to be Molson Coors. Ticker symbol TAP. Now it's down roughly 1% on the day, but when we look at the one-year chart, pretty ugly one-year chart. As I stated, this stock was trading close to $70 a share, dropped down to $49.50 on bad earnings, which is now leaving it in a single-digit forward PE and a dividend that's over 3%. So I'm probably going to run a DCF model on Molson Coors, but let's scratch the surface together. I'll kind of go through my process and show you exactly what I'm looking at. By the way, if you're new to the channel, welcome into Compounding Capital. My name is Colton, and we take a fundamental approach on this channel, diving into the numbers, but also looking at long-term price action. So when we pull up a long-term price action chart on ticker symbol TAP, Molson Coors, we can see here the COVID lows came in right around $34 a share. Stock shot up to over $70 a share, now trading in the middle range here around $50 a share. A couple things have happened with this. We broke a trend line here from that COVID lows. We can see clear as day that a trend line has been broken. And now where is the bottom going to come in? So what I want to do is kind of just look for some lines of support that are approaching. What we want to look for, if we're looking at Molson Coors, I want to see where the price action is going to stop. And we can see here that there's going to be multiple areas where we may want to build into this stock. Right around $48 a share, and then an additional 5 to 10% drop from there would bring it right around $40 a share. So between $40 and $50 seems like a good area for accumulation when we look at Molson Coors. This has been an area of support and where we see buying pressure come in. And when we look at the formulation taking place here, what we want to see happen is it stop and get some traction and buying pressure around this trend line here, form a W much like it did over here, much like it did right here, and much like it did right here and here. So these W patterns are where we start getting bottom processes in Molson Coors. And the nice thing is when we look at the 5-year chart, every time a W pattern happens, what do we notice? Well, we get a higher high. We sell off, we get a W pattern, another higher high. We sell off, we get a W pattern. And could we break to newer highs on Molson Coors? And when I look at the fundamentals, I think the answer is yes. Let's break down this really quick. I don't even think we really need to get into a DCF model because it's pretty clear that this one is fairly priced right now. The first thing I want to point out with the fundamentals is there's been top line revenue growth growing from $10.5 billion to right around $12 billion. So steady 3 to 4% growth. Nothing really exciting about that growth. The question becomes, where do we buy it to take on that slow growth rate but have enough capital appreciation when we factor in a dividend as well? So when we're thinking about total returns, we want to factor in a 3.4% dividend, and we need right around a 7 to 10% annualized rate of return to kind of beat the market overall. When we look at free cash flow per share, we're looking right around double digits here, which is very, very strong, especially when we factor in the type of sector it's in. This is in your consumer staples / consumer discretion. People don't need Molson Coors, but it is that consumer staples. So when we're thinking of Molson Coors, a lot of times we're only thinking of a few brands, but as we can see here, this is a company that has well-diversified brands, with the bread and butter definitely being the Coors brand, but Foster's is a solid brand, Lion Kugel, another solid brand, Miller. So many brands under this umbrella, and the company's been steadily growing around 3 to 4%. Where do experts see them growing going forward? They're projected to do right around flat revenue growth while efficiencies pick up in the business and get EPS growing single digits here. I think this is pretty realistic to think that this is a company that's going to be doing 12 to 13 billion over the next few years. So I can definitely get behind these types of numbers that we're seeing with Molson Coors. Whereas the street expecting price action anywhere between $53 to $77, which means that the stock could be undervalued, currently sitting at $50.69. Dividend safety sitting at an A-, very, very low payout ratio. So this means a few different things to me. This could be a company that could be a compounder as we watch EPS growth and some sort of revenue growth. We can start seeing that dividend now pick back up and push probably closer to a 4% dividend yield. So not only are we getting capital appreciation if we buy at the right price, we could be getting a compounder when we look at dividend growth as well. Now, dividend history is at 1 year, but what I want to point out is this is a company that was paying dividends for multiple years and discontinued the dividend but brought it back. So overall, I definitely think we can attribute COVID and supply chain and worries leading to them cutting this dividend. But I think when we look at it re-implying the dividend, we see the growth. And when we start looking at the comparisons, I think you're going to see that this is a company that is actually performing better than its peers and trading at a discount. Now, when we just look at valuation here, the trailing 12 month, it is trading at 8 times earnings, while sector median is trading at 17 times earnings. When we go off of a gap basis on forward earnings, this is a company trading at 9 times earnings while industry standard is at 18. Now, even if we just meet in the middle and say this is a company that can trade about 12 to 15 times earnings, and they're going to be earning close to $4.50 pretty comfortably. So if we look at $4.50, we multiply that by 15 times earnings, we get a $67 stock price, which actually fits the suit of it being closer to a $70 stock. So while the quarterly report was disappointing, I think a $70 price target makes a lot of sense for this company for a few reasons. Number one, it has an above average dividend rate and it's able to cover that rate very comfortably with a 25% payout ratio. When we look at the free cash flow yield being double digits, very strong free cash flow yield. We also look, they are outgrowing their peers. So not only is it paying a higher dividend, it's trading for a lesser multiple, it's also outgrowing its peers. Now, the most important thing is going to be profitability. The net income is almost double to what its peers' net income is. So this company seems to have a competitive advantage in all aspects, pays a nice dividend, is cheaply valued, and this one is definitely on the board here of a stock that I'm very interested in for a long-term buy. I definitely want to get it between that $40 to $50 range. So once it breaks $50, that's probably where I'm personally going to start looking at it for a few reasons here. I get closer to a 4% dividend yield that could actually grow going into the future when we look at the payout ratio. We're also getting close to a 13-14% free cash flow yield on a consumer staple company that has a competitive advantage. Very solid buy, I believe, at these levels. So Molson Coors, a little contrarian slide here for you guys as a consumer staple stock to keep an eye on. Now, maybe one area you can kind of poke a hole in with the company is going to be the balance sheet, but overall, I think this is a pretty solid balance sheet. Their total debt sitting at $6.22 billion. They have just under $1 billion of cash, and the company free cash flow is anywhere from $900 to about $1.5 billion of free cash flow. So when I look at the debt to free cash flow and the cash that's on the balance sheet, so I do think they can handle this debt. I still do believe they can possibly raise this dividend, and there is still nearly $800 million of cash on the balance sheet as well. So I think cash-wise, this is a company positioned extremely well. Not a lot of toxic debt on there, and they can handle this balance sheet. So now let's talk about another contrarian stock here that I think a lot of people are going to be mixed opinions on, and that's completely fine. I just want to bring the value up here. That's going to be Intel. This did not really participate with the recent rally of Nvidia, Micron, and a lot of the other big chip makers, which means that this could be a deeply valued stock if we see those companies sell off and Intel sells off along with them, because I do believe that earnings have troughed here, meaning that I do think we're going to see a reacceleration on earnings growth for Intel, not necessarily this year, but going into next year when we talk about an updated cycle for hardware and technology. Intel should still get a decent global proportion of chip manufacturing. Now, what I want to point out on the longer term chart is the downtrend that is still absolutely intact here. We have lower highs, as we can see here, and lower lows, and I do think we could actually take out these lower lows here just by looking at the chart. There's no real turnaround quite happening yet here on Intel. So now we have to really lean on the fundamentals to see where we think Intel should be trading from a fundamental standpoint. This is basically just being thrown out, disregarded, and the price action is showing us this, and it could absolutely go lower and break down to newer lows. As you guys can see here on the 5-year chart, it did hit a bottom of $25.91, Currently, the stock is trading at 23 times forward earnings, but I think we all understand this is a very foggy forward earnings guidance here. We really don't know what they're going to do. We don't know how much market share they're losing. We don't know how much market share they're going to regain. A lot of questions with Intel, and that's being priced into the stock here. Overall, I would say the balance sheet is definitely questionable, but with the government stimulus, it definitely puts their balance sheet in better shape. So right now, I think the balance sheet is okay, but we want to watch that burn rate on Intel. Now, this was a company doing over $71 billion in revenue, now doing $54 billion in revenue. If we put that in perspective with NVIDIA doing 60 to 70 billion and projected to do over $100 billion in revenue, NVIDIA has now become one of the most expensive companies, if not the most expensive company in the entire stock market. And the crazy thing is Intel was doing the same type of revenue as NVIDIA is, but wasn't getting that extreme multiple that it is getting because it wasn't growing. It was basically staying stagnant. Intel stayed fat and happy, and NVIDIA came out and ate their lunch. And so now we're dealing with this battle of, do we go into a company like NVIDIA, or do we look at NVIDIA like a Tesla? Now, hear me out really quick. When Tesla was the first company to kind of go to market as an EV, it got an extremely high multiple. The stock was trading for over $400 a share. Fast forward to today, the EV market has now become competitive over the last 3 years. Tesla's now trading for half that valuation. And so the question now becomes, do we buy the Ford that can compete with the Tesla, or do we buy the Tesla? Meaning, do we buy NVIDIA at these higher levels and hope that they can maintain that competitive advantage? Or do we start looking at the contrarian companies that have a high revenue rate, still getting $50-60 billion in top line revenue? Can they pick up those efficiencies, invest in the future, and catch up to the valuation of an NVIDIA? And this is where investing gets unique. And this is where individualized investing becomes important, because now I'm starting to look at it at Intel still as a player in this field, even though it's not being priced as a player in this field. You know, whereabouts do I think we can see it go? Ideally, I need to be buying the stock between $21 to $26 a share. That's about where I see the value for this company, with slow growth going around 4% growth rates. Now, obviously, if they can compete with AI chips faster than everybody anticipated, this is going to change everything. But what I'm trying to do is build some safety here and say they're just going to get the spillover effects of the AI boom, and they're going to just kind of stay steadily growing in an upward direction at 3 to 4%. And if they do that, I think you can justify anywhere between $21 to $26 a share for Intel. When we look at the chart, once again, is there an opportunity for it to reapproach these levels and kind of put a bottom in on this stock? And I think that's where we have to start looking at Intel as an interesting contrarian play and a possible catch-up play when we think about future earnings here. When we look at forecasters here, we have a price target as low as $17 and as high as $66. And when we look on YouTube and people talking about Intel, it's a very similar story. A lot of people hate it and a lot of people like it. Very few people are in between. I'm definitely one of those few that are in between. I think the future is very foggy for Intel. I think the efficiency of Intel is very foggy. But I do think that this $2 to $3 worth of earnings is making sense over the next 2 to 3 years, which means that it's basically trading right now at a close to a 10 times forward earnings, a 12 times forward earnings. When I think about we're heading into 2025 and I want to buy the stock, I'm thinking about adding into possibly Intel at the end of this year if the stock keeps selling off and heading down to that $25, $26 range that I kind of highlighted through my fundamental analysis. This is where I do think you have to start looking at the risk versus reward for Intel and it possibly catching up from an evaluation standpoint. This was a company that was doing over $70 billion in revenue, now doing $50 to $60 billion in revenue. A reacceleration of demand for Intel. Can they start competing when it comes down to an AI chip? And so when I'm thinking about buying it by the end of this year into 2025, I start have to thinking about 26 and 27. What is 2026 and 2027 going to look like? Well, they're developing newer chips, they're making partnerships, and they're building new fabs, which is telling me that there's a tremendous amount of CapEx going in. And when we look at the recent earnings, it seems like they have found a bottom, which means that the stock price will soon probably find a bottom as well. On this channel, we talk about stock price follow earnings. So if Intel's earnings can now start picking back up, we're going to see that stock price turn around fairly quick here. And where I think that starts happening is in the latter half of 2025, and that's why I think accumulation by the end of this year into the beginning of next, if we see if we see it trading in the 20s, makes a lot of sense from a risk versus reward profile. So as always, ladies and gentlemen, really appreciate your time. Hopefully you enjoyed my 2 stock dive in, and we will see you in the next one.